Now, within the ETF industry, the income-generating fund space is the latest to explode with offerings. Providers are looking for some novel ways to stand out. But as market conditions change, can returns stand up to those changing expectations? Joining me now is Adam Patty, the CEO of VistaShares, alongside Shelley Antoniewicz, the chief economist at the Investment Company Institute, or ICI. Thank you, Adam and Shelley, for being here with us right now. Maybe, Adam, I'll start with you, given that you are the fund operator in this discussion right now. Your company has been tracking some of the kind of bigger investing type names, one in particular, over the course of the last several months. And now you're about ready to launch another fund, tracking another notable hedge fund manager. Take us through what you're launching this coming week.
Well, thanks for having me. Yeah, tomorrow we are launching ACKY, and the strategy is to invest like Bill Ackman, but with 15% target income annually paid monthly. So we look to pay out 1.25% per month using an option strategy over all of the holdings in the portfolio. And the strategy mirrors exactly what we did with OMAH back in March, which is invest like Buffett, but with the 15% annual income. So that fund has been very successful, driving almost 500 million in 6 months. We're getting great feedback. Performance has been strong. So, looking to replicate that success and bring out unique strategies that help investors diversify their core equity portfolios.
Now, Adam, it is not to take anything away from Bill Ackman, but Bill Ackman maybe hasn't been around or a household name as much as Warren Buffett and Berkshire Hathaway have over the last several decades. So as you launched OMAH, which tracks the Berkshire portfolio with your income enhancement, what exactly led you to Bill Ackman to follow up as a second act to your Berkshire tracking fund?
Yeah, I mean, look, there's only one Warren Buffett. So you're one and done if you're trying to find another Warren Buffett. However, look, there are a slew of investors out there that have tremendous track records, who are absolutely brilliant, who have a lot of respect, and certainly Bill Ackman is right at the top of that list. So what we did is we went back into the lab and we looked at a whole host of different types of managers, and we tried to identify those managers that tend to have high conviction picks and hold their securities in their portfolio for a long period of time. So that really closed down the loop, right? So a lot of managers are out there doing a lot of trading on a daily basis, or they're hedging out certain exposures on their long positions. We were looking for high conviction managers. And certainly Bill Ackman is the best of the best when it comes to that. And we settled on working on his portfolio, doing the research, and then determining if we can, in fact, pull off a covered call strategy on his holdings, which after looking at many years of his portfolio, we determined, yes, we can. And we're bringing ACKY out tomorrow.
All right. So, Shelley, now I'll turn to you. As you look at things from kind of like that high perch from the Investment Company Institute, which is the trade organization, of course, that represents many mutual fund and ETF managers out there. We've talked a lot about the evolution from passive, ETF type products, indexing type products, into this more active stock picking type space. Just how quickly is that product growing, the kind of tracking star managers type product, and maybe perhaps just active ETFs at large?
Active ETFs have really taken off. They're going to be a big topic here at our inaugural ETF conference. As you can see, the sign behind me. So I'm beaming in from Nashville. And active ETFs right now are $1.1 trillion. And there is hundreds of billions of dollars a year that have been coming into organic growth into active ETFs. Active ETFs cover a range, just a whole range of strategies. Many of them are focused on cutting edge technology. So you have ETFs that are looking at AI. They're also looking at cybersecurity. But if we want to go back over to high income ETFs, high income ETFs are super popular as well. And we've got an aging demographic here in the US. The baby boomers are solidly in retirement, and they're looking for these types of income streams. that Adam was talking about. And so high income ETFs are great because they can help, because of this steady income stream, they can reduce the overall volatility in the portfolio. They typically use dividend paying stocks, high yield bonds, and as Adam mentioned, these option strategies to also add income to the portfolio. If you just look at the dividend paying, high income dividend paying ETFs, there's over $350 billion in assets. And those got $20 billion in inflows in early September. So there is strong demand for the product.
Shelley, what exactly, I mean, you mentioned some of the demographic tailwinds driving some of these income producing type strategies. I wonder if you could also take us through a little bit about just how you see some of these types of income overlay on equity portfolio strategies, what type of role they play in an investor portfolio as they approach a time where income becomes more of a priority. Where do they fit vis-a-vis, say, a high yield bond fund or an investment grade bond fund or a treasury type fund?
I think that the high income strategies where they're looking at or they have stocks in the portfolio, dividend paying stocks, and the overlay of the option strategy, that actually helps provide a bit of a diversification. It also allows, with the exposure to the equities, it also allows some of these funds to have some upside risk. Now, if you're using a covered call strategy, some of that will be mitigated, that upside would be mitigated, but you have to remember that the portfolio is receiving premiums from writing those covered calls, and that is helpful for investors looking for income.
Adam, the covered call aspect of a portfolio, in essence, it means that you're selling options, call options, at out of the money levels above the current market for the portfolio overall, generally speaking, and then using those option premiums to enhance the returns and then pay them out. My question to you is, we have been living in a very low relative volatility regime for months, quarters, if not years at this point. Maybe an exception can be made for the Trump tariff announcements that came out in April, kind of through the early part of May. There was volatility there, but in a world where volatility is not as existent as it has been over the last several years, what exactly does that do to the type of options writing that you have to do to generate the returns that you are targeting?
It's a great question, and that's why you need to do the research. So, as volatility goes down, it certainly gets more difficult to generate those premiums. But the key for us is, well, first of all, it's the research looking back in history at different volatility regimes to ensure that, in fact, we can make our numbers. But I think what's important to understand is that we're not waking up in the morning and trying to maximize our income, right? We are trying to hit 1.25% per month, which is a modest amount, actually. We're not, if we generate more than 1.25% per month, we're going to roll it back into the NAV. And in fact, if our underlying holdings generate dividends, that's being rolled back into the NAV as well. So, we don't want to maximize the income. We want to be stable and consistent to hit that 15% on an annual basis. And, our research indicates we can do that in any type of volatility regime. We also have the ability to use different option strategies, not just covered call strategies. So if things really tighten up, we can switch around the strategy. We can even use index options if we need to. But for now, I think we're all set with our covered call strategy that covers the entire portfolios.
Okay, Adam, it was Berkshire to start and Warren Buffett. It is now going to, starting tomorrow and this week going forward, be Bill Ackman and Pershing Square. What exactly has been the demand profile that you've been evaluating from the investors that you are, in essence, polling to see the types of products that you are bringing to market and what types of managers? You mentioned the idea of having concentrated picks, kind of best idea stock pickers out there. But as we look down the line, can we expect more funds in your mind to come out that are tracking kind of like these star type managers?
Yeah, I mean, when we filed for this product, ACKY, we filed for a slew of other ones as well, based on our research. So if this does well, we can certainly bring out others. This is not everything we do, but we think it's an important piece of it. And, we're just going to make sure that whatever we do bring out We underpromise and overdeliver, and has a high quality portfolio, and is designed properly for different market conditions. So we hope this is the second of a family of similar products that we could bring out in the future.